By the way, my next guest is also optimistic about the equity market. In fact, just added to the firm's overweight. I'm going to bring in J.P. Morgan Asset Management, their managing director, Phil Camporeale. And Phil, let me start where I left off with the other Phil. Okay.
Phils are wild today.
Yeah, Phils are wild. Italian Phils. Who knew? I mean, you got to see. Let's talk about the wild cards. Let's do it the reverse way since I've got this screen up. Are you concerned? Are there any sort of things out there on your radar that could upset the party?
I think the one thing that we're probably most worried about in a total optimistic view is whether the Federal Reserve becomes a shadow kind of cabinet position. And that is a low-risk event, low-probability event. But of those wild cards, we do think that probably the Federal Reserve is one of the biggest.
It's already political, though, to a degree. I mean, like if Harris won, I think Leon Brainerd would have been in there. I think she would have done Harris's bidding, but not as open. So I think we're edging to that direction anyway. But I hear what you're saying there.
Yeah, because that's an environment where foreign investors that buy our treasuries would say, we need to get paid more to hold your treasuries. And then rates going up kind of upsets the apple cart.
All right. Now let's talk about sort of similar to what the other Phil said. You tell investors, hey, ignore the noise, right? We're going to kind of bring up some of the things that are out there and just focus on what's kind of really happening, right? Fed easing, low recessionary probability. You like the financial conditions here, rate volatility. Let's start with the rate volatility, because that's something that a lot of people are pointing out.
Yeah, that's the most important signal for us right now. So what do we mean by that? The equity market has something called the VIX. Everybody knows what that is. That's equity volatility. The fixed income market has something called the MOVE index, which measures rate volatility. Charles, do you realize that rate volatility is at its lowest level since the end of 2021, before the Federal Reserve went crazy with tightening policy? That does two things for us. Remember, I'm an asset allocator. It allows us to buy stocks here because nothing gets equity investors more nervous than there's rate volatility. But it also, really importantly, allows the fixed income in the portfolio to have a traditional relationship, negatively correlated with equities, defense in the portfolio.
Does that offset the notion that the 10-year won't get below 4?
There's no reason for the 10-year note to go below 4%. We have a 2.3% GDP forecast for this year and a 2.5% inflation forecast. 2.3 plus 2.5 is almost 5% nominal growth. That's about where the 10-year Treasury should be. There's nothing controversial about the 10-year.
There was an interesting article in Bloomberg about Harvard. You know, they created this investing style, a lot of public investing, particularly overseas. And the orange dot folks are Harvard. So for the last 20 years, it's been amazing. It's outperformed. 10 years has outperformed, even 5 years. But more recently, it's cracked. The reason I borrowed this chart, though, is because I know you like the 60-40 portfolio. I've been frowning on it for the last few years. And, you know, for the last year, it's kind of come back a little bit. The 70-30 has done better. I prefer people have more equities than bonds, but you're in a different position. Why is it okay now to be in a 60-40, a traditional 60-40 portfolio?
Yeah, and most of it has to do with the 40, not the 60. So again, the fixed income side of the portfolio. Coming into 2025, Charles, fixed income had a negative 3-year rolling return, and there was nowhere to hide in fixed income. So the 60-40 portfolio, we think, is really driven by the 40 and fixed income behaving. But if you do add alternatives, we're not averse to that. Could add another 50 basis points of annualized return.
Well, like, could alternatives now, I mean, because there are, like, we're opening up private equity to a lot of our viewers, and there's all kinds of things that are making money for folks now that didn't before. What metals count as that?
Yeah, so alternatives provide AID, an alpha source, income, and extra diversification. Things like commodities, private equity. In a world where there's financial deregulation, fiscal activism, alternatives make sense in this environment.
You're overweight U.S. emerging markets, high yield credit. So you're overweight. I mean, you're in this market. I want to ask you, because you had a comment in your notes about the AI trade. You think it's durable. You know, I started the show showing how it's spread out. All of a sudden, it's about memory. Someone forgot, hey, we're mining all this stuff. You know, we did the picks and shovels. Eureka, we've got it. Now what do we do with it? We can't store it anywhere. Do you see it spreading also beyond that? Because now, last year, Caterpillar was an AI stock. I did a story about a toilet maker that's an AI stock out of Japan. You see that continue to...
Government took a stake in Intel last year and all that. Yeah, we do see it broadening out besides just the 7. And this goes back to the One Big Beautiful Bill Act. Permanent extension of the full depreciation of domestic R&D. If you do CapEx on AI, you give yourself a tax break. And that was one of the most overlooked things of the One Big Beautiful Bill Act that we think creates durability. And then even going back to last year, the first half of last year, AI CapEx was bigger than the U.S. consumer at a time when people were pulling their hair out around tariffs. So we also think it's durable because it's somewhat economic agnostic at this point.
Great stuff, Phil. Thank you very much. Really appreciate it.